Well, we love talking with you about our ag commodity trade. I'm Marlin Bohling, your tour guide to these ag commodities. Happy Thursday to you. Well, the markets are up and running. Let's go ahead and see what they're doing now that we have our export sales numbers out of the road, weekly numbers, and we had an overnight number too. By the way, we sold another 327,000 tons of corn to China. Well, let's look at corn. Did it benefit from that or not? Not much. It actually opened up unchanged. We have May corn now $0.015 higher is all at 657.5. But again, you have weakness in December. It's down 3/4 at 554 3/4. Just can't keep up with the nearbys. Look at the spread, over $1 wide now. On soybeans, you have the nearby May 12 1/4 higher at 1516.5. That's within about 6 cents of its high from last night. And new crop November. Now 9 3/4 higher at 1317.5. Boy, it has launched itself quite a ways away now from that $13 benchmark that it was testing yesterday. And on the wheat in Chicago now, it's going the other way. You have May down 8 3/4 at 670 3/4 per bushel. July down 7.5. Kansas City wheat down 14 1/4 at 849 1/4 on that May contract. July down 11.5 cents today. In Minneapolis wheat, you have the May contract down 6 1/4. We're at 853 3/4, and July down 5.5. And we'll go ahead and talk about cotton. No extra charge here. We have the July contract 48 points higher at 82.87, and now you have December, the new crop month, 33 points higher at 82.76. Well, we have Chris Swift on the line with us to talk about today's trade. He is with Swift Trading. He's based right here in the Nashville area. All right, Chris, the soybean trade seems to have a little bit of a mind of its own here this past couple of trading days. Ever since the WASDE report came out, it's acting a little bit independent from all the others. How come?
It is. A lot of it seems to be due to the soybean meal demand again. We noted 2 months ago there was enormous soybean meal demand. We pushed prices up to $500 a ton, backed them off some, and now we're starting back up again. And clearly with the inverted carry that we've got with the May, carrying almost carrying a 31-cent premium to the July. I tell you, they got to have beans out there, and with the crushing still out there and the crushing margins profitable, I think there's just good demand on old crop beans right now.
So if we can bring up our quote board here on soybeans and also on the corn, if you look at that spread relationship between the nearbys and the new crop months, now in soybeans, for example, I mean, it's just within about a penny of $2 wide. On the corn market here, it's over $1 wide between the nearby and that December contract. There, it's $1.03 wide. I mean, is that irrelevant? Does it mean anything in the bigger scheme of things?
Well, I think what it tells you is that we're really expecting a good crop this year, and that's not an abnormal spread. If we go back into the 2008, 07, and 08 time frames, we saw similar where the corn spread, when we finally went off the board on the July, December was already $2 lower, and $3 and $4 lower in the November beans from the previous old crop. So this year, we got to look back at 22. We say 22 was not as good a year in the crop production, so that's what we feed on all of 23. So it is a little bit tighter supply, but from our prospective plantings report, seems like we're going to get additional acres in corn and no less acres in the soybeans. So with a new crop and improving weather, maybe we increase those supplies towards the end of the year.
Well, boy, we're making some tremendous progress when it comes to corn planting and soybean planting, for that matter, from the reports I'm getting from the field. So anyway, good luck to everybody and stay safe out there. Man, they're putting in some long hours these days getting all that crop put in. If you don't mind, Chris, come back here in just a moment, and then we'll talk about this livestock trade on a Thursday right after this. Well, we're back talking with Chris Swift. Now let's focus over on livestock trade and on the livestock market with our quotes provided by Bar Chart. Look at these contract high prices once again today on live cattle. Here we go. We have the June contract up $1.17 again today. We're at 166.05, set a high of 166.27. Man, oh man, they are really getting after it this week. August up 57 cents. The nearby April, which is in delivery, is actually $2.20 higher, but that one is not traded all that much. All right, now on feeders. Here we go. Over $1 higher everywhere. You have the May contract now up $1.05 at 209.62, and August up $1.22 at 226.97. Gosh, I remember about a week or a week and a half ago, we didn't know if it was going to be able to hang on to $200, and now we're almost at 210. In fact, we cleared it for a little bit this morning. Then you get to the lean hogs this morning, and well, as of right now, we have the May contract 77 lower. We're at 80.75, and June down 85 cents at 86.70. Go back to Chris Swift here and talk about this a little bit. You know, we had talked earlier in the week about the spread between cattle and hogs, and some folks have been saying, well, how can it get any wider? And yet, Chris, it just continues to get wider all the time.
Yeah, this is how it does it. And we see the lean hog index soft again today. And right now, I think it just has to do with the shorter supply of beef than it does any greater demand. We know there's not that much greater consumer demand. We've seen that fresh retail beef prices are up again. Box beef prices are up. So all of this is being pushed into the consumer. But something we noticed today, Marlin, in the June contract, and maybe a couple of the others, the 3 gaps were made today. They have been made in the June contract. So we got a breakaway gap on March the 27th, a midpoint gap on April the 6th, and today potentially an exhaustion gap. We may have several more to go, but at least you started to lay in on what they consider the old-timey names for the gaps that they had there.
So now, just for those that don't maybe watch charts all that much, when you have a breakaway gap, you wait for the second one, right? And you usually call that a measuring gap, and you find the distance between that. And roughly, you take that amount and put it on top of that, and that's where you find that exhaustion gap, where it usually runs out of gas. Did it work out in that formula this time, if that's the case? You're
very close to it. So let's see, that first one up to there was about $6. And so this one from 160, and we're at 166.27, $6. They look dead equal right now.
Oh boy. So it really did alter.
Something fun to look at for the day.
Oh my goodness. Well, thanks for pointing that out. That is extremely interesting, where it doesn't always work out, but wow, that'd be weird if it did this time. Okay, so caution signs, maybe an exhaustion gap, maybe not. Maybe it's another launching point. Thank you, Chris. I appreciate it. Chris Swift of Swift Trading Incorporated, and he's based in Nashville. And oh my goodness, what technical sign that would be. Oh, I don't know if he'll top or not, but it's interesting.